chartered accountant. I deal with a lot of clients. Some are sole traders, some are limited companies. And I've been asked today to talk to you about the difference and why you should choose one structure over another. I find that I do get clients coming who have already started a limited company, and sometimes they haven't actually considered, which is the best structure for them. So what I would say is always, look at the different structures before you make a decision, and choose the correct one for yourself, because it's easier to make the choice up front rather than trying to change things later on. In particular, I find people who are trading as limited companies who didn't need to be trading as limited companies. So sometimes, if in doubt, I would say start as a sole trader, and you can always do what we call incorporate, become a limited company at a later date. Okay, so we're going to just move on to the next slide, and talk a little bit about what are these business structures. When you run a business, you could be a sole trader or a company. There are some other structures such as a partnership or an LLP, which is a limited liability partnership. The partnership and limited liability partnership are more where we have more than one person involved in the company and we need to split the profits. So they're slightly more complicated, and we're not really covering that today, but just so you are aware. Companies are different to the other business structures, so to the sole trader, the partnership, or the LLP, because they pay a different kind of tax. So they pay what we call corporation tax. On the other hand, sole traders and partnerships and LLPs, they pay income tax and national insurance. So the sole trader structure is linked to the individual's tax return. And the difference with a company is that a company is separate and it's taxed in a completely different way. I see at the bottom there, I put that companies are separate legal entities from the individual, whereas a sole trader business is taxed as part of your individual tax return. And that's something really important to understand, that when you set up a company, that company exists as a separate legal entity from yourself. And you have to look after that company as a director and shareholder of the company. But you don't actually own the money inside the company, it's owned by the company. And that's something that's quite important to understand if you are running a company.
Yes, thank you.
Now, sorry, did somebody have a question? Feel free to ask questions as I go along. If you want to interrupt, that's fine, just unmute. So what points should we consider when we're choosing which business structure to go for? Now, one of the main reasons to trade as a company is to get what we call limited liability. This can also be achieved by using a limited liability partnership. And that's quite a new business structure, relatively new. So why would you want to limit your liability? So this is particularly for businesses that may worry about their liability in terms of being sued, or their responsibility for the product. So if you have that kind of issue in your business, that may be a reason to choose to trade as a company. And that's not a tax reason, that's a legal reason. The other reason that sometimes people go for a company is where we've got multiple people involved in the business. And if we don't want to go as a partnership or an LLP, then by having a company, the different people involved can hold shares and we can split the profits. So that's another reason for choosing a company. Where we've got a single person trader, one person trader, the only reason normally, other than limited liability, for going for a company would be to save tax. And for most of my clients, that would be the reason where they become a company, is the tax saving. The threshold, or the point at where you start to make enough of a tax saving to justify trading as a company, is around £30,000. Now the saving has decreased in recent years, so I would say an absolute minimum now of 30,000. Where I have
per annum, I'm sorry, per annum 30,000
profit, yeah.
Annually. Yeah.
Yes. Yeah.
Mm-hmm.
Below that, you will only save a tiny amount of money, and that saving will be wiped out by extra administrative costs. So I mean, my sole trader clients, if I have someone a sole trader at around about 50,000 profit, then I will say to them, really, I think you need to think about, converting to a company. Between 30 and 50, it's sort of up to them. There is some saving there, but it's not a huge amount. So it's whether they want the additional administrative burden in return for a relatively small tax saving. And as I say, that tax saving is then offset. Obviously, once you get up to 60, 70, 80,000 pounds, then you are making quite a significant saving as a limited company. So but yeah, below 30, unless you need to be a company for other reasons, I would say remain as a sole trader. Okay, any other questions on that? You can ask at the end as well, of course. Okay, so we're just going to do a little overview of how a company and how companies work. So companies pay corporation tax on their profits. Currently, the corporation tax rate is 19%, but from April, which is obviously next week, the end of next week, the corporation tax rate is changing, and where profits are over 50,000, we go into a higher rate band, and that is going to also affect decisions in the future because companies are now paying a higher rate at that higher level. The rate is going up to, there's a marginal rate, so you're basically paying 26.5% over 50,000 up to 250,000 profit.
I'm sorry, this is 50,000 per year or per month?
Per annum. Everything is per annum that I'm talking about. Yeah.
Okay.
Yeah. Because the tax, where you're a company, you do a corporation tax return annually, and you pay your tax annually, unless you're a very, very large company, which there's different rules for them. But most companies, all the companies that I deal with, where profits below $1 million, you pay annually, and you pay your corporation tax 9 months after the company year end. So there's quite a big lag between your starting your trade, ending your year, doing your tax return, and paying the tax. Okay, so this is the point I was making before. If you trade via a company, the profits of the business belong to the company. So it's really important to always keep enough funds in the company to pay the company's liabilities. And this is where I sometimes see clients running into trouble, where they trade through a company, they take the money out of the company as dividends, they believe, but they don't leave enough inside the company to pay the corporation tax, or if relevant, employer taxes and VAT. And that then gets them into a very difficult position from a tax point of view because they've taken too much out of the company. So I always recommend that you keep really good business records and use an online system. And a lot of the online systems will tell you how much you can take out, what's available to extract after the tax from the company. So funds from the company are taken out either by salary or dividend. So most of my clients pay themselves a small director's salary, and then the most tax efficient way to take the balance of any money is dividend, which is taken out of after-tax profit. As an individual, the director shareholder is then taxed on their income, so their income will be the salary and dividend, and they still have to do a self-assessment return as well. So company, now to compare that, just a quick overview of the sole trader. So when you're trading as a sole trader, you pay income tax and national insurance on your profit. And this is something we have covered in the other courses, but just quickly to go over that. So your sole trader profit is then taxed If that's your only source of income, which I'm assuming here it is, your first 12,570 is your personal allowance. So you don't have to pay any tax on that. And you then pay 20% tax up to 50,570 and then rising to 40%. And there's higher rates over 100,000. And you also have class 2 national insurance, which is a set rate, and class 4 national insurance. And it is actually that class 4 national insurance, which is a tax on self-employed profits, specifically on self-employed profits. And that class 4 is the main reason that it becomes more efficient to trade as a company. It's that class 4 that makes it more expensive to be a sole trader. And so it's really important to be aware of that. Okay, so let's have a look at a tax comparison. And this is coming back to the levels where it's better to be a company. So on profits of £20,000, the tax saving of a limited company is only around £130 per annum. Again, this is everything per annum. And this would be more than offset by the additional costs of running a company. So that's where I come up with that limit of 30,000. At that level, the saving is around £500, and that should cover your additional administrative costs, but only just. So it's a sort of break-even point there, I would say, once you cover the tax saving covering the additional costs. Once you go up to 50,000, the tax savings rising to around £1,500. So at that point, if your administrative costs are, say, £500 extra, you're £1,000 better off. Another thing to consider, which a lot of people aren't aware of, is that when you're starting a business, you often make losses in the first few years. Now, if you make a loss as a company, you can carry those losses forward against future profits, but you can't offset them against your other income. So sometimes I have someone who's perhaps worked in a job during the year and they have some other income, and then they start a loss-making business, the loss for the first year while they get things set up. A loss in a sole trader business can be offset against your other income, and that can be quite beneficial. So for that reason, it's often advisable to start business as a sole trader until the business becomes profitable. So you start off, you might make losses in the first couple of years, you might start to make a profit. Once you get up to between 30 and 50,000 profit, I would then incorporate the business and continue to trade once it's established as a limited company. What some of my clients do actually is, if they know this is likely to happen, they sometimes want to reserve the name of the company, a company's house. So they set a company up as a dormant non-trading company, and we just keep it in the background, ready to take the trade over when we're ready for it. So that's an option to do that. We're going to talk a little bit more about the limited liability that I referred to. And this was one of the reasons for choosing a limited company. So this would be a reason that you would choose a company if you need to. So as a company, the liability is limited to the nominal value of the shares. And the nominal value of the shares is often between £1 and £1,000, depending on how you set it up. So unless the director has given personal guarantees, which is sometimes required for loans, then if the company becomes insolvent and cannot pay its debts, then the director is not personally liable. That is only the case if the director has acted in accordance with company law and hasn't breached any laws. But provided the director has traded, within the law, then they are not personally liable for any losses of the company. If a company does become insolvent, then it must cease trading and not continue to incur debts. Okay, other reasons for trading as a company. Now, this is quite a big reason that a lot of my clients do trade as limited companies. And this is something called IR35, which is a piece of legislation that's been around for quite a long time now. And it was brought in to stop employers disguising employees as self-employed contractors. And for that reason, a lot of larger companies who employ contractors will only employ them via their own limited company. The reason for that is that should HMRC question or inquire into the taxes, and if there is a tax liability, if the contractor was self-employed, the tax liability would fall onto the employer. However, if they're employed via a limited company, it falls onto that limited company. So the employer is shifting the risk from themselves to the contractor's limited company. It is quite a complex area, but really it's the reason that a lot of limited one-man band limited companies were set up and are in existence. So that's a reason a lot of my clients, they have no option. They have to trade via a limited company in order to get the work. So that may be applied to some of you. And the other reason for trading as a limited company, other than the reasons that we've already covered, is where, again, we've got multiple people running a business together. And you do have some options for that. You have the options of a partnership, an LLP, but sometimes a company is the best option. So you need to get advice in that sort of situation. I'm going to go on now and talk about the administration of a company. So just to cover, I referred before that there were some costs around a company. So all companies have to file accounts annually with Companies House. The accounts that they file can be abbreviated. They're called micro entity for smaller companies. They have limited information, but they are required to be filed. In addition to the accounts, you have to file what's called a confirmation statement annually, which is really a form confirming the standing data and with a filing fee of £13. And all companies, whether they trade or not, dormant companies, have to file accounts and this confirmation statement. So that's two things that have to be filed with Companies House. Once a company is trading, in addition to the Companies House filing, you have to file full accounts. So that's full accounts with a profit and loss account, filed with HMRC, along with a corporation tax return. And you have to have specialist software to prepare these accounts and tax returns in the right format. And so for most people, they need to pay an accountant to do this, to prepare those accounts and tax returns. Accounting fees for a company start for a very small company at around £400 per annum. So you can see that really the minimum administration costs are going to be around £500. In addition to the company filings, the company directors also have to file a personal tax return to show their salary and dividends. In comparison to that, the sole trader doesn't need to file any accounts, and they only have to file a personal tax return using the self-employed section. So the administration is much easier and much cheaper than for a company. I'm going to talk a bit about salary and dividends from a company. So when you're a sole trader, you can take funds directly from the business. You just need to remember to keep aside enough money to pay your tax and national insurance. And a lot of my clients will keep a separate tax savings account for this. When you trade via a company, it's a much more formal process. So firstly, if the company is paying the director a salary, and if that director earns over £520 per month, then the company has to register as an employer with HMRC. It has a separate registration and make monthly real-time information submissions. So again, you've got another administrative cost there. I always recommend that my directors take a salary at the moment at £758 per month. At that level, it keeps the administration down because there's no employer or employee national insurance due, but the director still gets state pension credits and entitlement to state benefits. But as I say, because it's over £520 a month, they have to make these payroll submissions. So for most of my clients, I do that as part of their accounting service, so they don't have to worry about it. Some of my clients make their own submissions, so it's up to them how much administration they want to do. And so I've covered that about the payroll system. We're just going to continue that a bit more. So once the company has paid the director's salary and any of its other costs, what's left is the taxable profit. After working out how much is due in corporation tax, then the company has left what we call distributable profits. And this is the amount that the shareholders of the company, who may be the same people as the directors, can take out as dividends. The dividends, the directors are taxed on their salary plus their dividends. And because dividends are only taxed at the lower rate, and I've put there 7.5%, it's actually increased now to 8.75%, but it's still much lower than the other tax rates. So because the dividends are taxed at that lower rate, up to 50,570, and because there's no national insurance due, this is why we get the saving in the company, the tax saving. So that compared to what I said before, the class 4 national insurance for the sole trader. Okay, so that's really sort of covered most of what I was going to say about company. I'm going to just do one slide about closing a company. And the reason I'm covering this is, again, just to sort of emphasize that the closing process for a company is a bit more complex. You can't just stop trading. There's certain things that need to be done. So again, consider this before setting up a company. Because a company is a separate legal entity from the directors, it has to be closed down when it's no longer required. If the company has no debt and its total assets are £25,000 or below, then it can be dissolved at Companies House via strike-off, which is a fairly simple administrative process. And you can do that online. And the cost is £8 for the online form, and it takes around 3 months to complete. But if the company ends trading and it has more than £25,000, then you need a more formal process to close the company down. And it's a little bit confusing, but the solvent companies with assets over £25,000 are generally closed down via what we call an MVL, which is a members voluntary liquidation. And you require an insolvency practitioner to do this for you. And the costs for that are at least £1,000. So that's something to consider as well. Where we're talking about an insolvent company, then it can be closed via a creditor's voluntary arrangement, a liquidation, or go into administration. And they also all incur insolvency fees. So final points, a company should not be set up without due consideration, as there are considerable administrative and legal duties. I would advise anyone who's running a business who thinks that they want to trade via a company, if they have a choice in the matter, to take professional advice before going down that route, as most likely you're going to need to involve an accountant to fulfill the reporting requirements. And so it makes sense to get some advice up front to check that it is the right structure for you. And whatever structure you decide to use the technology that's available to help you with the reporting.